All right, so I was in New York City late last night, and I drove past a couple of these NBA championship watch parties. I mean, all these neighborhoods, it was phenomenal, right? And as I'm driving from neighborhood to neighborhood, you can see people were nervous, but one thing, they were always hopeful. And obviously, it's been a magical year for the New York Knicks, underscored by the deep well of resolve that they've had. And I can tell you the same can be said about our economy and certainly the stock market. This morning was iffy, but it's turning into a really good session with green across the screen here, even stronger for mid and small cap names. Now, my next guest remains bullish in the market near term for several reasons. I want to bring in now Turtle Creek Wealth Advisors Chief Market Strategist David Spika. And David, I want to start with this CapEx note that I saw from you. You say AI CapEx is actually a positive, where a lot of folks on the street see it as a negative. Explain why it's not.
Well, there's a couple of different ways to look at that, Charles. It's a positive in that it's driving earnings growth and it's driving economic growth. Now, I understand the concerns about the ROI on that CapEx, but one way to invest in that, where you don't have to be specifically concerned about the ROI on that CapEx, is a picks and shovels approach, investing companies that are benefiting from that CapEx, but aren't significantly or materially leveraged to that CapEx. And so that's one of the reasons why we still like it. And clearly, that's a big factor in driving the 23% earnings growth we're expecting for this year.
Right. I mean, the money is cascading down, and it's not just technology, right? I was just looking during a break. Comfort Systems up $100, $101 right now. The resilient economy, how surprised are you at how resilient this economy is?
I'm a little surprised, Charles. When the war started, you had to think that rising oil prices and rising interest rates and uncertainty would have a negative impact on the economy. And this economy and this market has been extraordinarily resilient through this entire process. I think today's a great example. We're seeing a lot of money on the sideline willing to buy the dips. And when you look at employment, you look at consumer spending, and you look at GDP, there's still a lot of strength in this economy. Consider where we'd be today if we hadn't gone into Iran. No telling where the market and the economy would be. But even with that, and with the positive things that should occur from that, we're still seeing all new highs in the S&P 500 and a strong economy and a strong consumer. So it's very positive.
And the peace dividend is going to be with us, I hope, for a long, long time. You like equal weight. You know, earlier this week, someone came on the show. They liked equal weight. It looks really great on the charts, coming off a double bottom. But it really is picking up momentum. You think investors are looking to branch out here?
Well, year to date, and again, there's been some ebbs and flows, but year to date, the equal weight S&P is ahead of the market cap weighted S&P. But the reason we like it, two things: it signifies a greater health for the market. So we're not completely dependent on the Mag 7 for stocks to go up.
Right.
But it also means that investors are starting to recognize the value in some of these other names, some of these non-Mag 7 names, some of the companies that will benefit from AI but aren't part of the Mag 7. And we like that. And to us, that's a healthy way to invest, and it's a great way to have a diversified portfolio.
Materials is an area that I've been looking at closely. A lot of guests have looked at closely. It's been something of an underperformer. You like Martin Marietta here. The chart is not necessarily attractive, but it certainly seems like the fundamentals, this is a buy here.
Yeah, the chart is not attractive. You called that one, Charles. But when you think about what they're leveraged to data center construction and onshoring of industrial facilities. They produce aggregates and concrete and asphalt, and they're going to benefit from this growth. Now, one of the reasons that the stock has trended down, they've had good performance this year. Their last quarter was very strong with double-digit revenue and earnings. There's concerns about input costs, primarily energy, and there's concerns about a weak housing market. But once the straits opened again, that energy cost comes down, and that gives them a nice tailwind to benefit from data center growth and industrial facility growth.
I want to ask you about Costco. It's been interesting to me that on the retail side, we've seen lower end retail names that do really well, and higher end retail names are coming on pretty strong. Costco, I mean, this is one that you typically put in your portfolio, never think about it, but it has been going sideways lately.
Well, the valuation got a little ahead of itself, Charles, and you can see that on the chart. It was trading at a pretty lofty PE, and so there was some profit taking in there. But again, back to fundamentals, this is a tremendous value play for consumers in an area of pricing pressure, and consumers are looking for cheaper deals. It also has the membership model, which is a wonderful, sustainable revenue growth opportunity for the company. And again, this last quarter, their third quarter numbers, double-digit growth in revenues, earnings, and membership fees. I shopped there myself. I just paid an extra fee so I could show up an hour early and beat the crowds there, Charles.
Yeah.
So it's a great model.
Yeah, I love Costco. And by the way, Sam Walton, when he was alive, said the only company he couldn't beat, he thought he could with those Sam's Clubs, is Costco. Hey, David, great stuff. Thanks a
Amen.
lot. Nice talking to you.
Thank you, Charles.
All right, talk to you again real soon.